Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. Great to be with you today. We're going to be chatting about 3 keys to success in 2017. And we're going to do 3 things today. First of all, we're going to look at 2016, look at some lessons learned. Number 2 is we're going to look at what do we do with market all-time highs. That's some of the narratives we're hearing from the press right now. And then third is with the coming regulatory tax, meaning income tax, corporate tax, estate planning, capital gains, you name it. Some of those changes that are coming in here in the near future, how do we cope effectively with those? So let's jump right in. Let me start with the lessons learned in 2016. Let's do a quick review of what we saw in 2016. I don't know if you remember, but we started off in the first 6 weeks of 2016 was the worst ever January in the beginning for the equity markets in U.S. history. From January 1st through February 11th, there was actually north of an 11% drop in the S&P 500 in a mere 6 weeks. Then we had the Brexit, which happened there in roughly June timeframe, and in less than 2 days, we saw that the U.S. equity markets lost 6%. Talk about volatility. And then third is the night of the election, from 7:30 to roughly about 12:30 in the middle of the wee hours of the morning, the Dow was poised to open down 870 points. So extreme volatility. So when you look at those 3 time periods in 2016, we saw significant downward swings, a lot of fear, a lot of concern, a lot of volatility, a lot of uncertainty. How did things end up? That brings me to our first lesson learned for 2016. For the year, what I have here is 2016 returns, not including dividends. Notice the S&P 500, which is U.S. large cap companies, ended the year right at 12% return for the year. Look at the emerging markets measured by the MSCI Emerging Markets Index was up around 11. The Russell 1000 value, which would be large cap value U.S. companies, was up around 17%. And the Russell 2000 value, which is U.S. small companies that have a value till were up north of 31% in 2016. Wow, terrific returns during a year which we saw tremendous volatility and uncertainty, and 11% pullback back there in the first 6 weeks of the year. So what did we learn for 2016? Number 1 is if you have a plan and you stuck with the plan and discipline, you won. You got rewarded with handsome returns here by year end. Number 2 is that we saw a return to what we call the premiums for value stocks and for small stocks. Years prior, we had seen that premium not present in the marketplace, but if you remain disciplined with your plan like we work with our clients, we saw where the small premium came back with a vengeance, and so did the value premium for 2016. Now let's move to the all-time highs. What do we do with all-time highs that we have them in the markets right now? You see a lot of that in the press. So what I have here in this chart is what we measured is every time the market hit an all-time high, that would be the S&P 500. Then we looked at the next 12 months after the all-time high. We looked at how likely was it that you hit another all-time high. So the green bar shows that north of 80% of the months after we hit an all-time high, we hit another all-time high, versus only roughly 74% of the time where the market closed anywhere, just all values, that we then proceed to have an all-time high in the next 12 months. So what does this mean? This means that if you have an all-time high, it actually, statistically speaking, there's a slightly higher chance that you'll continue to have all-time highs in the next 12 months. Of course, no guarantee with that, but this shows when you really look at the data, that hitting all-time highs is just a normal occurrence. Another way to think about this was just after World War II, the S&P 500 was somewhere around 14. I'm not missing any zeros there. Now it's well in excess of over 2,000. So from 14 to over 2,000, how many all-time highs did the market hit? Many times. That's just a normal occurrence as we can see the equity markets continue to rise. Last but not least, the third thing is what do we do about the coming changes from a new administration, and that'll affect obviously quite a few things politically. What do we do with new income tax law, capital gains, business tax rates, deductions, estate tax, gifting, some other things we might see, maybe regulatory changes, maybe we see changes in healthcare and Medicare. And maybe we even see some changes with Social Security. What do you do with all that? As soon as we see these actually be enacted into law, we'll do another thing just like this, another video, bring you a narrative of how do you think with and assess the situation. Every situation comes with threats, obligations, and opportunities. How can we think with it? And then B, what actions do you need to be in then, right then, to be successful? So there in summary, the 3 keys to success in 2017 is number 1, lessons learned in 2016, discipline and having a plan worked, both with remaining invested and tilting towards small and towards value. Number 2 is how do we cope with all-time highs? It's a normal occurrence. Stay with your plan. And then number 3 is, as we know there's coming changes, stay tuned, plug in with us, give us a call. We'll be releasing narratives on how to cope with those situations and what actions you need to be in. Wish you the best of success. And if you're interested in a second opinion of your situation, if you're not currently working with us, please let us know.